Hi, everyone. Thank you for joining today's webinar, Interpreting Factor Anomalies, How They Contribute or Destroy Alpha. As always, today's webinar will be recorded and made available for viewing within the next few days. After the presentation, there will be a short Q&A session, so if you have a question for Cheng, you can submit it in the text box on your GoToWebinar panel. Our speaker today is Cheng Peng. Cheng is currently a software engineer at Betterment, the largest independent online financial advisor. Betterment manages more than $10 billion in assets for 280,000 customers. Prior to Betterment, Cheng worked across multiple industries such as AIG, Blackberry, Textnow, and Viafly as an analyst, software engineer, and startup founder. His passion for finance and technology drives his independent research. Cheng will also be a speaker at this year's QuantCon in New York City, which is next week. You can learn more about his talk and get tickets to the event at www.quantcon.com. Thanks, Cheng.
Cool. Thank you for the awesome introduction. And as said, I will be on QuantCon, so if you have a chance, come by and listen to my talk. So a quick disclaimer, everything here is my opinion and is not financial advice. And you should really look for financial advisors for that advice, and everything here is unaffiliated with anyone else. To start, I want to talk about what are anomalies. And really, they're just irregular occurrences in data that differs from the norm. And I want to stress norm, because if we don't know what's normal, we do not know what is an anomaly. So the key here is to understand what is normal and what is a deviation. And there are really two categories I put this in. One, it's highly dependent on the data, particularly the frequency, linearity distribution, and the type of data. And as examples, we can look at intraday data versus monthly data. And we can see that the intraday data usually has much higher sample size, meaning we have more statistical significance when determining whether a point is an outlier or an anomaly. And in monthly data, we don't have that benefit because there's less sampling data and it gives us less confidence. And the next thing I want to talk about is the price data versus fundamental data. The data types are relatively pretty important when we look at outliers or anomalies. And we can really think about how price data is really updated daily and really often, or even minutely, versus fundamental data is only updated once a quarter. But the most interesting part is fundamental data isn't standardized. So between different stocks and different practices and different sectors, these variables mean different things. And things that could be a standard accounting standard might seem to be like an anomaly, when really it's not, unless we look at the industry itself and accounting practices in that sector. And the second thing I want to talk about is how anomalies are highly subjective to the model or objective function you are really using. We can assume that intraday data versus monthly data is really driven by frequency. But when we look at intraday prediction versus monthly prediction models, it's possible that we can use a lot of intraday data accumulated to do a monthly prediction. So we separate the difference between the data itself versus the model itself. And I want to also stress that it's important to consider the model's prediction, because the nuances would change the assumptions of whether something should be considered an anomaly. For example, a 10-minute short-term momentum run can really mean different things when doing intraday prediction versus a monthly prediction. And in the monthly prediction, you wouldn't even care about really when you enter the trade very much at all. Another point is really the difference between market timing models versus factor models. And the key here is to understand that market timing models are less frequent. They look for the perfect entry, the perfect exit, instead of a very general, a non-timing model like a factor model. And in a sense, these timing models are focused on exploiting anomalies. Since if you think about it, when you time an entry trade, when you time an exit, and it produces some sort of alpha, that's in itself already an anomaly. And obviously in factor models, we don't do any of that. We assume constant leverage, except for risk management. And we assume that there is no anomalies that isn't already explained by the factor model itself. So hopefully we've introduced a bit of why anomalies are extremely useful in your research and development process, and certain things to consider. And I want to focus on two extremes. So we've highlighted how anomalies can be bad or good. Specifically, anomalies are really bad when your model strays farther from the intended hypothesis just because you want to fit the outliers. So when you fit outlier data for higher recall but lower precision, meaning that, oh, sure, you have more positives, but you also have more false positives. And we know in quantitative finance, false positives are very deadly, and it's something we want to avoid at all costs. Anomalies can be good when we have models that target uncommon conditions, when we look to exploit extreme situations. So an example could be looking at underpriced equities due to sell-offs institutions when they do what they call window dressing in order to make the portfolio look better, and they sell equities because they want to really make the client happy. Another event could be an event-driven strategy that focuses on extreme announcements or outcomes of earnings or what have you. And in those cases, if your model is really focused on those areas, or it takes into account those situations, then it could be that anomalies are actually good for you and an arbitrage opportunity. So today I want to talk about the case with factors and factor models. Generally, factor models are continuously rebalanced portfolios. They're always invested. They want to exploit a sustainable edge over time, and it massively hedges risk using a large number of holdings since it cancels out all the noise in between. And this means that factor models are actually quite sensitive when you're trying to understand a difference between a real edge or alpha versus just bad risks that you shouldn't take. And in these cases, outlier events or data can easily affect the model negatively in a way where the difference between real edge and bad risk can be hard to tell. Another point I want to touch on is how we can manage both risk and returns by the magnitude of holdings. Since in factor models, we are massively hedging the risk using a large number of holdings, we can increase or decrease the holdings in order to manage how much risk or whatever that we want to take on. And there's definitely multiple ways to do this, many ways to do this. But today I'll focus on these three univariate ways. There are also other sophisticated methods. So the first one is really starting from basics, the difference between z-scoring and just basic ranking. Secondly, I'll talk about how Winsorizing versus truncating can change our universe and make our signal different in good and bad ways. And thirdly, talk about how rolling returns correlation can be used to determine whether a stock can or cannot be considered an anomaly based on just how well it fits, how well it's correlated to the benchmark. Other sophisticated methods that I want to bring up that everyone here can read up later. The first one is the KNN, basically K nearest neighbors distance sorting, where for every data point, you could look at the K nearest neighbors, calculate the distances, and get a score from that. And we can assume that data points that are very far away from the neighbors are generally considered anomalies. In a similar way, we have the local outlier factor. It's more density-based versus distance-based. But for local outlier factors, we actually look at the density, or basically the clusters of data points near a single data point, to understand really how much of an outlier it is. So in a sense, you can look at it as a data point that's very lonely should be considered an outlier. And starting with basics, we'll go talk about z-scoring. Really, that's just normalizing values by demeaning and inversely scaling with the standard deviations. So we can see doing this makes them more dynamic, more flexible in multiple cases, but it can also lead to biases if the data set is heavily skewed. And an example could be some fundamental data that is normally very positive. And when you remove the mean, you still have a very positive z-score skew versus a negative z-score skew. However, it really depends on interpretation. Z-scoring itself isn't a bad thing. It's how you use that information that's really important. And for the second one, ranking, that's much more simpler. This normalizes all the values by assigning consecutive ranks. And we can assume it's much more robust because of the generality. But it could hurt statistical significance in signals because of lack of consideration of the actual standard deviation of the factor itself. Next, between Winsorizing and Truncating, Winsorizing really transforms extreme values by replacing them to a specific percentile below it. So as an example here for numbers 1 to 5, when we Winsorize the bottom 20 and top 80%, we get 2, 2, 3, 4, 4. So numbers 1 and 5 become 2 and 4. Truncating, quite similarly, with the same percentile numbers, would do the same thing, except to actually remove the data entirely. So the numbers here would be 2, 3, and 4 instead of what we had before in 2, 2, 3, 4, 4. We see the average of both of these results seem to be the same at number 3, but it's actually quite dangerous when we do truncate these values and we lose a lot of data points that could significantly affect the signal, could be for better or for worse. And here we'll talk about the rolling returns correlation. And the concept intuition behind this is really that stocks can be compared cross-sectionally if we compare the returns to some sort of benchmark. And that's really the capital asset pricing model, and the understanding behind that is very common across the financial industry. So 3 techniques I use for calculating correlations. First, I'll talk about the Spearman rank correlation that does very well for understanding relative ranking. The Pearson correlation that helps us understand positive or negative linear relationships, and linear regression with ordinary least squares for residuals and fit. And really the whole point is we can assume that low correlation to the SPY generally assumes that the stock is an anomaly itself because it cannot be explained by general concepts of the benchmark. And going forward, I will demonstrate these techniques with a few examples and how they really look when we try to apply them in real life scenarios. But before we can do that, for convenience and comparability, I want to first consider a bunch of common factors that we can use across the rest of the presentation so that we have some sort of understanding of if something has done better or worse. I decided to choose the common factors: the value, size, volatility, short-term reversal, and finally momentum. And the numbers I chose for this are the book value per share, the market cap, the monthly price standard deviation, the weekly price returns, and finally the 12 minus 2 month time series momentum, which is essentially using the 11-month momentum but removing the most recent month in order to reduce the noise in the recent returns. And to know, all this comes from Quantopian, and analysis are generally done through Alpha Lens, which uses the Spearman rank correlation of forward returns as the standard to regress to. So here I decided to rank and z-score these 5 common factors between the time period of 2010 to 2016. And I picked out 3 particular data points that I find most useful: the T statistic, the alpha, and the beta. So we noticed immediately that the T statistics are almost identical. And I thought this was a programmatic error at first, but it's not. And this actually makes a lot of sense because in Alpha Lens, it uses the Spearman rank correlation. And we see that the ranks and the z-scores don't change too much regarding to the common signal itself. But the interesting part is differences in the alpha. So we see in the ranking method, the alpha is actually higher for the momentum and the market cap, whereas in the z-scores, it's a much more even across the board. And we also see that in z-scores, the beta values are also absolutely higher than it is in the ranking, possibly because z-scores consider the variability of the factor and therefore explains most of it away through beta than it does through alpha. So for Winsorizing, with the same idea, with the same period, 2010 and 2016, I decided to pick a couple percentiles, 1, 5, and 10%. And the reason for that is I find it pointless to Winsorize beyond that because it would just detrimentally kill the signal we're looking at. So we see for every single common factor, really Winsorizing beyond 1% just makes things worse, or tends to make things worse, and there's really no benefit in doing it. And we also see that the betas on the right side are consistently lower as we Winsorize more and more of the data. Just for reference, Winsorizing only reduces the universe and the data set, but it doesn't necessarily give us a signal. So choosing between z-scoring and ranking, I decided to use z-scoring so that we compare them relatively, and that should be used across really the rest of the presentation. In contrast, for truncating with the same time period and same percentiles, we see that truncating has much less marginal benefit. We see how when we truncate 1, 5, or 10%, there's really no pattern. And really the T-stats are all over the place, the alphas are all over the place. And so we can conclude how truncating is generally worse than the z-scoring, sorry, Winsorizing, and that we'd want to do Winsorizing instead of truncating, and because of the information we have more in Winsorizing. And we notice on the right side also the betas are still consistently lower. And for rolling returns correlation, there's lots of ways to really do the inputs. But for what I did, I looked at the 5-day returns, and then I used the 21-day look back for all these correlation tests with SPY as the target. So for absolute Pearson and for Spearman, I arbitrarily chose a threshold of 0.7 because I assumed that represents that the stock has high correlation to the SPY, to the benchmark, and is considered not an anomaly. And we see that, however, the t-stats and the alphas are significantly lower than what we had before, which is the raw z-scoring or raw ranking. And that isn't actually that surprising because we've explained most of it away because of the correlation to the benchmark SPY. So it looks like this doesn't work either. So these techniques we've tried before doesn't seem to do much in reducing the outliers to improve our common factor signals. So I decided to look at it in a different way. How about we look at more concentrated portfolios, or as I mentioned, concentrated factor models. So instead of holding large factor portfolios with heavily reduced risk, concentrated factor models are really focused on the smaller portfolios that have higher statistical significance. And the 3 examples that I will go through is I want to inversely investigate the outliers that are normally detrimental. So here we'll try looking at the absolute factor z-scores that are larger than 2, stocks with extremely low correlation to SPY, and how event anomalies contribute to our common factors. For factor z-scores larger than or equal than 2, we see that the results are wildly different than it was before. We see book value per share is now considered significant with an alpha of 0.119. The market cap is now negatively correlated versus positive from before. And we see that numbers all over the place. And the main reason for that is because when we do the z-scores larger than or equal than 2, we massively reduce the available universe. And now we don't have enough stocks to give us the significance and comfortability to actually trade these because of scalability issues. And for reference, to get an idea of how bad it is, out of a universe of maybe 2,000 or so stocks, when we do the z-score, we only end up with about 10 or so. So we have to throw basically all the results out in the trash because we can't really use them in any sort of beneficial way. So the next step is trying low correlation to the SPY. And similarly with what we had before when we did the high correlation tests, with a low correlation of 0.3 for both Spearman and absolute Pearson, I ran the tests for these factors to see what we would get. Unfortunately, it seems that although the t-stats are similar and alphas are still similar to the progression of what we had in just normal ranking or normal z-scoring, the t-stats and alphas actually get slightly worse. So they don't really get improved. And unfortunately, the universe is still quite small. As you'd imagine that most stocks are correlated with the SPY. So in general, we don't want to use either of these methods to really give us any portfolio or increase our significance of our signal. So finally, I'll move on to event anomalies. And generally, we want to avoid events because we don't really account for them in our models. Unless your model specifically accounts for these events, I think generally avoiding these events will reduce volatility and improve factor returns. The events I really filtered out for are the quarterly earnings, the M&As, the 13D activisms, the buybacks, and dividends. And there's more events. There's lots more data, lots more information. However, I decided to stick with these 5 since they're easily accessible and they make the most sense to everyone. However, to note, exceptions do exist with time-sensitive news releases that could contribute to the alpha itself. So one example could be earnings momentum itself and how the actual earnings announcements contributes to the momentum and pushes the prices even further. As you know, all these data sets are from Quantopian and everyone can go online and just check them out if they want to see what the data sets they have and how you can use them in our tests. So we have to understand how to avoid event anomalies. And in this situation, I decided to do a control test by avoiding all the stocks that have any mention of these events within 21 days of the occurrence, before and after. So before 21 days of earnings announcements, after 21 days of earnings announcements. And this way we account for all the events in different ways. And I want to stress that we always want to use point-in-time data for these situations, because we don't want to easily overfit when just looking at the date itself, or whether the revision doesn't have point in time, which results in a very bad backtest. And the results are surprisingly good. So in the top table, we see the z-score from 2010 and 2016, the 5 common factors. And we see that when we remove the events, we get much different results, and I would say better results across the board. We see how the monthly of volatility factor has increased significantly. We see the market cap T-stat has increased significantly, and most surprisingly, the book value per share has went from insignificant to a significant signal that we can now trade. I want to just focus on the momentum factor, and that's because we're doing a very univariate approach to this whole event anomalies. And we notice that screening out these explainable events can really drastically change our factor results for the better or for the worse. And here we look at the deciles basically of the momentum factor after removing all the events, and we see how it's very comforting that as we go from the first decile to the 10th decile, we see that the higher deciles have higher performance and the lower deciles have lowest performance. And perhaps it's very interesting to see that most of the alpha does come from the short side, perhaps referring to the fact that multiple market participants like momentum on a positive side, but not on a negative side. And just for confirmation, here we see the cumulative returns by quantiles, 1 to 10, and it still supports our thesis quite well. So at this point in the day, this is when I put this into the backtest, and I'll see what numbers pops out in the top and bottom deciles. So here it uses the standard quantopian QTD universe. We see Sharpe ratio is above 1, which is nice to have. The beta is generally pretty low, and we do have alpha between 2010 and 2016. However, the caveat here is we're testing data between 2010 and 2016, so momentum does do well in that period. And when we test with different trading regimes, we will definitely get different results. So this backtest is definitely not indicative of something we should trade immediately, but it's interesting to see how removing events has improved the momentum signal so much that it does become profitable in this time period. And just to finish off the conclusion, there are a couple takeaways I hope everyone can take away from this presentation. And that first, that we really have to understand the data, and particularly the frequency of the data and really the type of the data that we're looking at, because that really contributes to how we understand an anomaly and whether an anomaly should be considered an anomaly or a good or bad anomaly. Secondly, is to really understand your model and really understand how you want to use your model, in a sense, to describe what numbers or what information should be considered appropriate or statistically significant. And this really helps in driving whether something should be an anomaly as well, or whether you want to look for these anomalies. And finally, it's just that filter out events that cannot be explained would really improve your performance. And that's because when we remove all the different types of cases or use cases that we can't explain with our original factor model, we'll get a much better result because we have a much cleaner signal when we do filter out these events. And yeah, cool. So thank you for joining us, and thank you for listening to my talk. And I'll let Phoebe take it from here.
Yeah, great. So we'll move on to the Q&A portion right now. We haven't gotten any questions so far. So if you have a question, you can submit it via the text box in your GoToWebinar control panel. We'll just wait a minute if any questions come in. And if not, you're always free to send your questions to events@quantopian.com, and we will pass them along to Cheng, and he can get back to you. So we'll just wait 1 minute and see if any come in.
Yeah, so I'll start answering these questions. One question is, will the backtest used in the presentation be made available on the forum? Yeah, totally. I can make that available. It's not public yet, but after this, I can totally make a public post about this so that everyone can get an idea of what the backtest looks like. Yeah, and similarly, I will also post a notebook for this relevant research that I have done. And just clarification, the question here is, what is t-stats? T-statistics is just another way to infer the statistical significance of the signal you're looking at. You can look at it in terms of also p-values or in terms of information coefficient. There are very similar ways to describe how confident you should be for one of these signals. Here it says, how do these anomalies impact the alpha? So generally, these anomalies can impact the alpha in really different ways, right? When we look at these anomalies, we can either choose to include them or to remove them because it's very subject to the data and to really our model itself. And really the specific impact really depends on anomaly you're talking about. For example, you could extract away a specific earnings announcements from your factor returns and understand the difference between whether to include it or not to include it, and with that control test, understand what the difference is for each particular anomaly. And just to note, question here is, did we use the linear OLS here? Sorry, I did not manage to get that in time. So just to clarify, when we looked at the Pearson and the Spearman-Rand correlation. Here it says, what sort of process do you go through in looking for anomalies, and when there are clearly opportunities to be exploited? Well, really, it's really hard to determine what to do when you're looking for anomalies, but the easiest way is to look at things that would be out of the norm, like news. I would say news is generally an anomaly. Events or structural changes are generally anomalies. Spin-offs, FDA approvals, a lot of things can be considered anomalies, and it's really how you interpret them. And there's definitely different ways to interpret them, and often it's actually not very clear whether or not there are opportunities to be exploited. Yeah, and then here's an awesome question. Do you foresee further collaboration with the Q community? How might that occur? So yeah, totally. In fact, I'm talking at QuantCon, so I'm definitely very involved in the Q community, and I'd love to share whatever my knowledge is and really do more talks as I want going forward. The question is, do you remove unintended risk to make more of a pure factor? Not directly for each common factor, but an example, the most recent example with the event anomalies, when you remove all these events, you do get more pure factor because you remove all the risk related to your earnings announcements, to M&A announcements, to 13Ds, and to all the activisms that happen to occur in the markets every day. Here it says, do there exist automated ways to detect anomalies? And yeah, definitely. There are a lot of unsupervised methods or unsupervised machine learning methods to detect anomalies. And it really depends on how you want to define them. Again, even these unsupervised methods do have parameters you have to optimize for. For example, the KN nearest neighbors. And in those cases, you have to really you really assume what is K, right? Do you want 4 neighbors or 5 neighbors or 10 neighbors to give you a score, to give you the result that you consider an anomaly? Here it says, at what time can you ignore at what time frame can you ignore the event anomalies? And that's a very good question. It really depends on the anomaly itself. So for really earnings announcements, there's been papers I recall that explain that when the earnings announcements go out, there is a changes in the market prices for these stocks itself. And it's very interesting today. It's very interesting to look at how you can change that to a weekly or even a quarterly anomaly. But for earnings, for example, since it's already quarterly, you probably don't want to use a 63-day window for that. And yeah, that's really all the time we have for the questions today. So if Phoebe can jump in on this one too.
Okay, great. So thank you, Cheng, for a great presentation. We're really looking forward to having you at QuantCon this year. Thanks, everyone, for joining. And like I said before, the webinar has been recorded. It'll be made available within the next few days, posted on our website, and sent out via email. We will also send a copy of Cheng's slides on that email. And yeah, if you do have any further questions for Cheng, you can send them to us in an email at events@quantopian.com. Thank you, everyone, and thank you, Cheng.